Welcome to Euromoney. The US corporate bond new issue markets are heading for a record month in August. Now, one of the key drivers to this has been the recent increase in demand for US Yankee bond issues. That is, overseas borrowers issuing debt to US investors. I recently spoke with Mark Bamford, he's global head of debt syndicate at Barclays Capital in New York, and we discussed the reasons for this increase in demand for corporate debt. Here's what he had to say.
Markets like certainty. The markets may not like the news per se, but certainty of some news is better than uncertainty on the same topic. So we have positive news and then we have certainty around these other events, which has created a situation where investors are willing to put money to work. And we've had issuers looking to finance for a very long period of time, particularly Yankee financial institutions or non-US financial institutions. I would describe it this way. In the U.S., there's not a backlog per se. U.S. industrials, U.S. corporates have been financing in the term markets for 2 years. 2008 was a record year for industrial financing. 2009 was a near record year. So we had two very big years in terms of industrial financing. And when you look at industrial financing through the first 6 months of the year, it's down pretty meaningfully as compared to 2009 and 2008. So there's not an industrial backlog per se. The issuance you're seeing at these kinds of levels, so when IBM prints a 3-year transaction with a 1% coupon, the U.S. Treasury was a 1% coupon. So you see borrowers, sophisticated borrowers coming in and taking cost of financing at levels that have never been seen before. So it's not a backlog per se, it's more opportunistic and just companies lowering their cost of capital. I think where the backlog has occurred is in the Eurozone, where just sort of step back and think about big numbers. The international new issue market, primary market, syndicated market last year was a $4 trillion market, and a third of that is in euros. So if you go into a period where no one can finance, no one, for 2 months, that's going to put pressure on the system, and that financing's got to come somewhere, and it needs to go somewhere. And so Yankee financial institutions have been keenly focused on the dollar market, and what we've seen over the last several weeks has been a very healthy supply of product into the dollar market, into investors who are now very interested in buying the product. We're seeing those same financial institutions finance in euros as well, so they're availing themselves of each of the major currencies. I would say, I'd answer that a couple ways. One, what individual investors are saying about the results of the stress tests and what the markets are doing are two different things. There are many examples and commentary, many examples of commentary on the stress test, and they often go along the lines of nothing new, that was what was expected, not surprised by the results. Yet when you add up all of those not surprised by the results and compare it to the buying behavior after the results as compared to the lack of buying behavior before, something happened. So I personally, again, what I read into that is fixed income markets like certainty. Even if it's disappointing certainty, even if it's what was expected certainty, certainty creates buying behavior, and that's what we've seen. So the very accounts 6 weeks ago that wouldn't buy any Yankee financial institution at any level, 4 to 6 weeks later, are actively inquiring about a variety of different European financial institutions. So what's being said and what's being done don't necessarily add up, but again, certainty with some other things going on has created an environment in which there's a keen amount of interest in buying European financial institutions in the States. A broad array of financial institutions have access. There was a question many of us had, when the markets reopen, will it be quote unquote core Europe, or will it be peripherals? And the answer is that there appears to be a price for a variety of different financial institutions, which is good. That's a sign that issuers may not like the price and investors may think it's not enough, but as long as we're having that argument, we're okay, right? As long as we're arguing about the value, we're fine. It's when we can't discuss the value because there is no bid or there is no offer that we get into trouble, and we've had that happen, time and time again over the last few years. I think what the U.S. market has shown over the last couple of years has been a robustness and resiliency despite all of the problems and issues that we've all been dealing with and reporting on and working through. The U.S. and particularly the investment grade market, the U.S. investment grade market has been incredibly resilient. And this year, when Eurozone ran into the issues that it did, and we saw activity drop so precipitously, it once again was shown to be a very robust and very resilient market. And I think that's the takeaway. There's always two sides to that supply and demand. Yes. I mentioned earlier that industrial supply is down 45%. So typically we see assets come in and to fill the void, and the assets that have come in to fill the void have been financial institutions. Last year and late in 2008, financial institutions couldn't finance on an unsecured basis in the global capital markets. They raised money with government guarantees. That was end of 2008 and 2009. In 2010, they have raised money on an unguaranteed basis, and they have filled, not dollar for dollar, but they have filled that void that has been left by industrials that did all of the unsecured financing in 2008 and 2009.
So could you see, Yankee issuance consistently make up say half of all US issuance, or do you see it sort of normalizing at some point?
I think that's a high number over a long period of time. That's a high number over a long period of time. I personally wouldn't expect it to be half of all supply. I mean, already, Eurozone financing, you pull up, just take a look at the daily runs on new issues, primary activity in Europe, and we're back to even late July, early August, we're back to 10 to 15 deals a day in Europe. That in and of itself is going to reduce the amount of Yankee issuance. But I think the message of 2010 will be always have multi-major currencies. Be ready to go in multi-major currencies, because you just don't know. You just don't know what lessons have the last 3 years taught us. Don't assume anything about major trillion-dollar markets, or assume they won't be there, and make sure you've hedged your bets and you've got more than one route to market. I think that's the story of 2010.